Hi, this is Ron Janish, and this video is about eliminating headline risk. We're going to talk about the different vehicles that are available, and we're going to take a look at how this might have applied in an actual situation that we've been following for some time now. Okay, let's click over here. Okay, here I am. Oh, by the way, those of you that have been to my various sites where you get to see this picture, this was me before I was married. And this is a real picture. It isn't Photoshop. It was taken in Manila, about 2 blocks from the American Embassy. And if you look at my hand and you get a real close-up on it, you can see that I'm barely touching the tiger. And this is a live tiger. He's chewing on a piece of wood. And I made sure that I got there after lunch. Uh, I, I was rather tense during this experience. But, you know, what the heck? It's something you got to do, if just for the heck of it. So moving back to eliminating risk, what we did was before Christmas, we talked about a way of working the market and having a portfolio, a very diversified portfolio. And so Stephen did that, and he put up his very diversified portfolio. And these are the positions in the very diversified portfolio right now. There's lots of them, as you can see. They're all different kinds of stocks. Many of them have um, a market cap of over 1 billion. So I counted them up yesterday, and there were over 20 different positions. Like, here's a good example, E, for example. Here's another one. There's another one. There's another one. There's several more in there that have a market cap in excess of 1 billion, and that's noteworthy because if you can build a system where your typical market cap in a stock is over 1 billion, it winds up getting very, very interesting to hedge funds. Okay, and at a later point in time, what we'll do is we'll take the trades out of here and take a look at the ones that were only 1 billion plus and see how their performance did versus the rest. But right now, I'm going to look at this and take a look at what can be used in order to eliminate headline risk. And before we get into that, let's take a look at the kind of performance we've had in this. This is doing a variety of positions, and this account here was set up in order to do what I recommended in the video, was however you do this so that you get your feet wet properly, do it in a parallel account. I call it a parallel account because this is just like having real money in the market. There is virtually no difference, and you get the same rotten trades, you get the same horrible commissions, all that kind of stuff. So, except you don't get to have any of the profits. That's the bad news. Okay, so we can see that right now this account is up close to 109,000. All right, now where did it start at? Well, we started it at, this was right before Christmas, we told you about it, started with 100,000 in cash, and at the end of the day on September 11th had 60,000 in positions in there. And as you can see, this one goes long and short, and as of last night it had about 145,000 in positions. Okay, and as of last night the closing value was at about 108,000. So it was up about 8%, and it's pretty close to 9% right now. And this is in less than a month. And understanding what this kind of system is, if you know what, if you understand the logic behind it and the underlying premise, to have this kind of a return would be like, so what? I mean, if this kind of a return, if you have a return of 8-9% a month, it would pretty be, yeah, well, that's expected. It's just like saying, well, I have a motorcycle that goes over 80 miles an hour at times, which is very risky. And you'd probably say, yeah, well, motorcycles do that. That's expected. It's not a big deal. So Anyway, so what we're looking at now is the question of how to eliminate headline risk. Well, let's take a look at the vehicles that are available. One of them is to simply use what we'll call 3X. Okay, now 3X is nothing more than, something like this, which would have meant that on the 11th of, let's say your intention was to work the portfolio to have probably a maximum of $150,000 in it at any time. Then you might have bought $150,000 or the appropriate amount, whatever you had, whatever would have reflected what you had in your account on the day on December 11th. That would have been $60,000 worth of SPXU, which, since this is a 3X, you only really have to spend 20, okay, to get $60,000 worth of exposure, or theoretical exposure. Okay, so you might have bought, so let's, just for grins, let's say you bought your $150,000 worth at 38.14, and right now you're at 34 something. Okay, so you're down a little bit over 2%. Okay, now that's if you're going long only. The problem with this approach is, or the outcome with this approach is if you take $50,000 and put it in this, and then $150,000 and put it in stocks, if the stock portion of the portfolio does, let's say, 9% in a month, and this goes down, let's say, 2% in a month, then your net is going to be about 7%. Okay, so this will get you a lower net. Okay, so one of the problems with headline risk portfolio management is that generally they don't make money. And the reason it doesn't make money is because the underlying portfolio that they're betting against with this risk management routine is it doesn't produce enough. Okay, so let's take a look at the other approaches. The other approaches might be writing options or buying options. And let me get a drink here. If you're writing options, you have a bit more work, and writing options, you have a bit more cost. The theory is, in writing options, you're theoretically able to capture premium, time premium. So in theory, you might get a quarter or an extra 1/4% or another 0.5% or so, or maybe even a whole percent of your portfolio in premium, depending upon how you do it. Okay. And then there's the real simple process that I call index reverse. And personally, for this particular model, which is like, put it this way, it's for somebody who likes to play tennis and not spend a lot of time looking at charts, is probably very interesting. And how that works is this way. And index reverse is really simple. And so let's say on December 11th, they would have gone short, let's say, $150,000 worth of face value in the SPY, and right now it's about 146, which would result in being a loss of about 2%. The difference is that when you go short $150,000 worth of stock, and then you're also long $150,000 worth of stock, you don't have any, let's say if you have a portfolio of, let's say, 100,000, you don't really have any margin cost, and that's kind of neat. So you can leverage what you're doing quite a bit. So this is the simple, straightforward way that I like it, personally. So these are the 4 ways to do that. And what we're going to do is we're going to take a look at this model at a later point in time. I'll update it and we'll see how it does. And what we're going to do is we're going to strip out the stocks that, as you can see here, this is a 2 billion, 29 billion, 2 billion, 1 billion, 18 billion. We just went long this one today. And 2 billion on this one here. That's the market capitalization on these. And so some of these stocks are really heavy duty in terms of market cap. And who knows, they may do extremely well anyway. So that's the kind of way we're looking at this. And so if you decide that you want to eliminate headline risk, and let's define headline risk. Headline risk is something that really can't be foreseen, and or even if it can be, it may impact your entire portfolio. For example, we have this what I call the global cliff right now. Obama has said, Congress passed the laws to spend all this money, and we're not going to talk about spending cuts now. That's a different discussion. What we want to talk about is having the debt ceiling raised. And so that's why you have this stuff on television about the $1 trillion coin. And so if something crazy comes to pass regarding that, it'll probably impact the S&P, even though your chart patterns might be pretty and wonderful and all that other stuff. It'll impact the S&P big time, along with the other indices. And so the theory is that you can eliminate or at least substantially decrease headline risk using this particular model. And so, like I said, the one I personally prefer is the index reverse approach, and it just keeps things really, really simple. Okay, but remember that in order to use something like that to get rid of headline risk, you really need to have something that far outperforms the indice that you're going to be using on the other side. Okay, so I thank you for your time, and when you get a chance, if you haven't already taken the Andrews course, please do. Let's see, here we go. There we go. If you go to andrewscourse.com, you'll see this wonderful picture. That's Alan Andrews, a friend of mine from way back when. And we have the regular course and the expanded course. It's up to you what you would like, and we'll be glad to work with you on that. So I thank you for your time, and see you next time.